All right, welcome to this explainer. Today, we are rolling up our sleeves and doing a rigorous textbook equity valuation. We're putting the current stock price of Atlantic Union Bankshares, ticker symbol AUB, right on trial. We're going to sift through the numbers, extract the key inputs, and calculate this stock's true intrinsic value just to see if it actually holds up to scrutiny. To solve this valuation mystery, we'll push AUB's financial data right through our valuation funnel. First up, the market's claim. 2. Absolute valuation focusing on future cash. 3. Absolute valuation looking at dividends and income. 4. Relative valuation with the multiples. 5. Asset-based valuation getting down to the bare bones. And finally, synthesis, the final verdict. Okay, part 1, the market's claim. So right at the time of this analysis, the market has priced AUB's stock at exactly $37.91 per share. This right here, this is our starting line. And that brings us to the ultimate question, doesn't it? Is AUB undervalued, overvalued, or perfectly priced? Our job today is to figure out if that $37 price tag represents a bargain or a premium. We are setting aside all the emotions and market hype to look purely at the math. Let's lay down the baseline metrics. We're looking at a mid-cap regional bank with a market cap of about $5.46 billion. Now, it's generating a pretty modest return on equity of 5.23% and a return on assets of 0.84%. But, and this is a big but, it's offering a really solid dividend yield of 3.90%. So basically, the picture here is a stable, income-generating bank just with somewhat conservative returns on its actual capital. Let's move on to part 2. Absolute valuation, future cash. We're going to start with the granddaddy of them all, the discounted cash flow, or DCF model. The logic here is super intuitive. A company is literally only worth the sum of all the free cash it's going to generate in the future, discounted back to what that money is worth today using an appropriate cost of capital. Notice the sheer size of the cash flow component here. The source data gives us an enormous trailing free cash flow of $2.221 billion. Now, since a specific weighted average cost of capital isn't in our baseline source, we're going to plug in some very sensible standard assumptions for a regional bank, a conservative 2% terminal growth rate, and a 9% cost of equity as our discount rate. Make sense? We project those flows out, apply the terminal rate, and discount it all back. But wait, when we actually run that calculation, something completely breaks. Look at this comparison. The data shows a standard calculated fair value of $34.18. However, the free cash flow model spits out an absolutely absurd $498.22 a share. No way, right? Why does this happen? Well, standard DCF models notoriously break down for financial institutions. For a bank, a massive influx of customer deposits looks like a huge spike in operating cash flow. But fundamentally, that's a liability. They owe that money back to depositors. It is not true free cash for the shareholders. So we've got to toss that $498 anomaly right out the window. Which brings us to part 3, absolute valuation, dividends and income. Because the traditional DCF is a total bust for banks, we have to pivot to absolute models built specifically for financial institutions. Enter the dividend discount model, or DDM. Now, AUB has an incredible 15 consecutive yearly dividend increases. That is a stellar streak. So we take their trailing average yield of 4.10%, and we look at their 5-year dividend compound annual growth rate of 8.14%. Just to be safe, we taper that growth down to a 3% terminal rate and discount those expected future payouts back to present value using that same 9% cost of equity. This is a fantastic way to capture the value of the bank's most reliable method of returning capital to its shareholders. Alongside the DDM, we also rely on the residual income model. This one is kind of like a reality check. It anchors on the bank's current equity and asks, is management actually creating value? We take their 5.23% return on equity and compare it against our 9% cost of equity hurdle. Because the ROE is actually lower than the cost of equity, the model is telling us the bank isn't generating substantial excess economic profit right now. And naturally, that drags our absolute fair value estimates down into that more conservative mid-30s range we saw earlier. All right, part 4, relative valuation, the multiples. Let's put our forward-looking crystal ball away for a second. We're going to transition to relative valuation to see how AUB is priced compared to its own historical baseline. And right away, a glaring insight pops up. The current price-to-earnings ratio sits at 18.58. But if you look at their 3-year average PE of 15.39, well, that means the stock is currently trading at nearly a 21% premium to its recent historical norm.
Expanding our view to some other metrics, we see a very similar story. The price-to-book ratio is 1.07, which is almost 9.5% higher than its 3-year average of 0.98. Price to sales is largely flat. Also, you might notice that standard metrics like enterprise value to EBITDA are explicitly listed as NSA in the data. That makes total sense. Debt is literally raw material for a bank, not just a financing structure, which renders EBITDA completely meaningless here. But across the viable metrics, AUB is definitely trading at a premium to its history. So, what if we assume AUB will just revert back to its 3-year historical multiples? Let's do the step-by-step math. A reversion to the 3-year PE drops the implied share price all the way down to $31.40. A reversion to the 3-year price to book gives us $34.72. Both of these numbers are noticeably lower than the current $37.91 market price.
Okay, part 5, asset-based valuation, bare bones.
For our final valuation filter, we are stripping away literally all future expectations. No earnings growth projections, no dividends. We're looking purely at the bare bones, the asset-based valuation. We calculate the net asset value, essentially the book value per share, using a simple algebraic formula derived right from our data. We take the current price of $37.91 and divide it by the price-to-book ratio of 1.07. Oh, and keep in mind, AUB has a very low 0.17 debt-to-equity ratio, which acts as a fantastic marker of balance sheet safety for these assets. Doing that math reveals a strict book value per share of exactly $35.43. For a financial institution, this net asset value is essentially your fundamental floor price. It is theoretically what the company's net assets are worth right this second, per share, before even considering future business operations.
And finally, part 6, synthesis, the final verdict.
All right, we have run the gauntlet. Absolute, relative, and asset-based models. The heavy lifting is done. And when we bring it all together into our synthesis table, wow, the picture becomes incredibly clear. Once we appropriately toss out that broken $498 free cash flow anomaly, look at how tight this cluster of valuations is. Whether we look at the provided standard fair value, the relative historical reversion, or the hard asset value, the math consistently points to a very specific range, right around that mid-$34 to mid-$35 mark. To finalize our range, we've got to weight these results based on the bank's business model and the reliability of the data. So 0 weight to the FCF-DCF, but we heavily weight the asset-based NAV of $35.43 because book value is the most reliable anchor for financial institutions. We give a moderate weight to the historical price-to-book reversion of $34.72, and we use the data's calculated standard fair value of $34.18 as a really solid conservative floor. So what's the outcome? Our weighted final intrinsic value range sits clearly below the current trading price of $37.91. In fact, the source data explicitly calculates a negative 10.92% margin of safety. The verdict from the pure fundamentals is that AUB is currently slightly overvalued by the market. We know the numbers show it trading at a premium to its intrinsic value, but investing is rarely purely black and white. So, based on all these models, here is the final provocative question you really have to ask yourself. Does this bank's impeccable 15-year streak of dividend consistency actually justify paying a roughly 10% premium over its mathematical intrinsic value? That is the absolute key takeaway you should be pondering from this explainer today as you consider your own portfolio.